Welcome to the Planet MicroCap Showcase Vancouver 2024 in association with Small Cap Discoveries. I'm your host, Robert Kraft, and I'd like to introduce this keynote presentation, this virtual keynote presentation. It'll be hosted by Lynne Bolduc, partner at Fitzgerald Creditor Bolduc Riseborough LLP. Lynne, take it away.
Thank you, Bobby. I've been practicing law for so long now that I'm finally good at it. In any event, I've been a securities attorney for over 30 years now, and I have done thousands of private and public offerings. So I'm here to tell you how your company can raise money in the US. As a preliminary matter, there are only two types of offerings of securities that your company can make, either a private offering or a public offering. A private offering is not registered with the United States Securities and Exchange Commission, the SEC. A public offering is registered with the SEC, a process that usually involves a filing with the SEC and then a review and comment period. So a public offering is more involved than a private offering. There's typically only two factors that are the most determinative of what type of offering your company wants to pursue. The first factor is advertising, and the second is investor suitability. Regarding advertising, it has two components. The first component is advertising, the traditional advertising, such as posting your offering on your website, advertising it on social media, industry publications, hosting dinners, etc. But a second component of advertising is also what we call general solicitation. General solicitation means contacting people with whom one of your principals does not have a pre-existing substantive relationship. Pre-existing means you knew the person prior to your offering. Substantive means you know the person well enough to believe they are qualified to invest in your offering. Now, investor suitability generally comes down to whether a person is accredited or non-accredited. And in the US, an accredited investor is a person who has a net worth of $1 million US, exclusive of their primary residence, or an annual income of $200,000 US per year over the last 2 years, with the reasonable expectation of the same in the current year, or $300,000 US jointly with their spouse over the same 3-year period. So with that background, I'm going to launch into private offerings which do not allow advertising. A friends and family offering is generally where a startup company will begin to raise money. Friends and family is promulgated under Rule 504 of the Securities Act in the US, and using a friends and family private offering exemption, a company can raise up to $10 million every 12 months from an unlimited number of accredited and non-accredited investors. This is one of the upsides of a friends and family offering. You can raise money from non-accredited investors. Advertising and general solicitation are not allowed. This is one of the downsides of a friends and family offering. It is really an offering made to your friends and family, not friends of friends, only people with whom you have a pre-existing substantive relationship. A disclosure document is required, and you should use an agreement that people sign saying how much they are investing and has the general securities representations and warranties. Another downside to a friends and family offering is the concept of blue sky filings. In the US, even for offerings that don't require registration with the SEC, you have to make what is known as notice filings. It's pretty much a form that you fill out notifying the SEC and the states of residence of the investors that you are offering and selling securities with the federal government and in those states. These are known as blue sky filings. They don't need to be made until 15 calendar days after the date of the first sale in general and after the date of the first sale in every state. So in the US, you have to comply with 51 sets of laws, one federal and then 50 of the various states. And that's the problem with the friends and family offering. Not all states recognize it. So let's say you make a sale to a resident of the state of Washington. You have to find another exemption for your offering. And guess what? In Washington, the only available exemption can be the one that required 10 days prior notice. So now you blew the exemption in Washington. So the friends and family offering can be tricky. It is handy to raise a small amount of money initially, though. The next private offering that does not allow advertising is what is known as 506B, as in boy. This was previously the most commonly used offering for a private placement prior to 2013. So for many, many years, this is the exemption that companies used to raise the most amount of money before they went public. Under a 506B offering, you can raise an unlimited amount of money from an unlimited number of accredited investors and up to 35 non-accredited investors. The catch with the non-accredited for this type of offering is that if you are going to offer and sell securities to non-accredited investors, your disclosure document has to follow a specific set of rules and requirements. So it has to be very specific to these rules, not just in general disclose everything material about your company and the offering. Now, a downside is, of course, advertising and general solicitation are not allowed. You may not put your offering document on your website. You can't contact people you don't already know. You can't contact referrals. So it's rather limited. If you know a lot of wealthy people and institutions that want to invest in your company, it works. But otherwise, advertising is essential. Now, one of the upsides of 506B is that investors, when they subscribe or invest in your offering, they need only to check a box stating that they are accredited, either by having the net worth or the income. You do not need to verify that. You don't need to look any further into it. You accept what they say as true. This will be important in the next offering we discuss. Blue sky filings are also required for the 506B private placement. And unlike the friends and family we previously discussed, this has a blanket exemption in all 50 states and with the SEC. Every state is required to accept a 506B offering. So you don't need to be searching around for exemptions, and you won't vitiate your exemption. Now, moving on to private offerings that allow advertising. And this is where the best part of my presentation, in my opinion, comes in. In 2013, the United States enacted the Jobs Act. It stands for Jumpstart Our Business Startups. And interestingly, it was enacted unanimously by Congress. Both parties, both sides, everyone voted for the Jobs Act because it does what it says it's going to do. It helps start business startups, brand new companies, growing companies to raise money without an investment banker, because in the past, investment bankers weren't interested in startups. Too risky. They don't need enough money. They're not ready to go public. So they had a terrible time. But in the last 11 years, we now have an alternative. This is called Rule 506C, as in cat. And under Rule 506C, a company can raise an unlimited amount of money from an unlimited number of accredited investors, no non-accredited investors. Disclosure document is required and usually takes the form of a private placement memorandum, but unlimited advertising and general solicitation are allowed, meaning you can put your PPM, the private placement memorandum, on your website. You can put your PPM on a platform that advertises to potential investors. You can announce your offering on social media. You can put it in industry publications. You can give presentations. You can host dinners. You can put your offering on a billboard on the freeway if you like. The advertising is unlimited. It also allows general solicitation, meaning I could refer a potential investor to you. You could call them, send them your disclosure document. They could invest, perfectly legal. So what's the downside? The downside is the investors need not only to check the box stating that they are accredited, they need to verify to you as the company what they are representing is true. There's two ways they can do this. When we prepare a disclosure document, it includes the agreement where the investor signs and subscribes for the number of shares, for the dollar amount, and checks the box that they are accredited. We include a two-page form whereby the investor's licensed professional, such as a CPA, a tax preparer, a lawyer, a broker, a financial professional, financial planner, can certify that what the person is representing is true. For example, I check the box that says I have $200,000 in annual income. My CPA takes the form and checks off, yes, Lynn has $200,000 in annual income because I've been paying her tax returns for the last 3 years. Sign it, date it, done. That's the verification. If the investor doesn't want to use a licensed professional to certify or doesn't have one, they can provide any document to prove what they're saying is true, such as a tax return, a W-2, a bank statement, a brokerage statement, anything that proves what they say is true will work. We can also verify investors for our clients, and there's a lot of platforms out there that will do that at a very low cost. But in any event, that's the catch for allowing the advertising. And in a 506c offering, blue sky filings are also required with the SEC and the states of residence of each investor, but it's a notice filing and all the states are required to accept it. So they don't review your documents or comment on them, you just notify them. So 506c over the last 10, 11 years has now become the most widely used offering for a private offering exemption. So, and a lot of companies have raised money that they wouldn't have been able to raise, prior to this coming around in 2013. Now, I just want to briefly mention a private offering that allows advertising. It is only for California investors, so I won't spend a lot of time on it. But if a company is qualified to do business in California and knows people in California, you can raise up to $5 million from California residents only. And I bring this up because the suitability standards are lower than accredited investor standards. You can have a minimum net worth of $250,000, an income of $100,000 US, or a minimum net worth of only $500,000 US. There's limited advertising allowed in this California only exemption. It's called a tombstone. A tombstone looks like, a headstone in a cemetery. It has the name of your company, a brief description of the offering and the business. It's generally just one page. So the advertising is not unlimited, as we discussed in the 506c, but there is advertising allowed. Moving on now to public offerings. Prior to the Jobs Act, there really was only one type of public offering. It was the traditional IPO that we all know about. It had an underwriter. It went through the SEC. It took a little bit of time, cost a little bit of money. But when you went effective on your offering, you raised several $1 million and you got to be listed on the stock exchange, probably NASDAQ or the New York Stock Exchange. There are now more options for public offerings that I want to talk about in addition to that traditional public offering. The first one is called regulation crowdfunding, also known as Reg CF. This public offering is not used very often, but you can raise up to $5 million every year using this. And the upside to a Reg CF crowdfunding offering is the money can come from an unlimited number of accredited and non-accredited investors with investment limits. Non-accredited investor limits are either 5% or 10% of their net worth. So it is lower than the accredited investor. These offerings usually result in a lot of investors. So they come in handy if you need to get a lot of shareholders. For example, let's say you're going public in the future, NASDAQ requires you to have 300 shareholders. You could get a lot of shareholders through a crowdfunding offering of this type. And that is because these offerings must be conducted through either a broker-dealer or a funding portal, which is an entity that is already registered to conduct these offerings. You don't conduct them yourself. It has to go through this specific portal. Now, because this is a public offering, you are required to prepare a full-blown disclosure document and file it with the SEC. Financial statements are required, and we haven't really talked about that yet because private offering, the financial statement requirements are not that specific. They can be internal, it can be whatever you have. In public offerings, the requirements are specific. And for a regulation crowdfunding deal, your financial statements have to be at least reviewed by an audit firm, and sometimes they need to be audited. So it's an expense. And it also consumes a bit of time, particularly in a smaller offering. This offering also requires you to file an annual report with the SEC every year. So there is a reporting requirement. Now, the advertising is limited to a tombstone advertisement, like we talked about before with California, meaning it is just basically one sheet, one screen that shows the basic information about your company and the offering. That's all you can use, and it has to be by the internet, in print, or social media. So it's not unlimited like the 506C or like a traditional IPO. Upsides are blue sky filings are not required for this type of offering. As I said, this offering is not used very often, but can come in handy if you need to get a lot of shareholders. Now, a new offering that we have since the enactment of the Jobs Act, which is being used quite often, is called Regulation A+. We always had Regulation A, but no one ever used it because it wasn't worth the time or expense. It's been revamped now in the Jobs Act, and this allows you as a company to raise up to $75 million, so it's a lot, from an unlimited number of accredited and non-accredited investors. And that's a key point. You can raise money from non-accredited investors in a Reg A+ offering without investment limits or suitability standards. It's not even a question. You do have to prepare a document like the PPM. It's a disclosure document. You have to file it with the SEC, and it does go through that review and comment process that I mentioned at the beginning. It takes a little bit of time, but surprisingly, they promised it wouldn't take a long time, and it doesn't. It generally takes anywhere between 30 to 90 days to have your offering approved by the SEC. Another upside to a Reg A+ offering, unlimited advertising and general solicitation are allowed. As we talked about with that 506C offering, the advertising is unlimited. You can put it on your website. Brokers can participate. You can host dinners. You can announce it on social media, etc. Another upside is blue sky filings are not required. So the states don't get involved with this. Once you have the federal approval by the SEC, your offering is good to go. A potential downside is that if you are utilizing, there's two different components of a Reg A, a smaller one and a larger one. The larger one is the one I'm focusing on, the 75 million, because that's the one used most often. You have to have audited financial statements. Now, those financial statements don't need to be audited by a PCAOB registered audit firm, which is the Public Company Accounting and Oversight Board, but they do have to be audited by an accounting firm. So that might cost a little bit of money, but if you have or can obtain audited financial statements, this is a great way to make a public offering If you can't do the large public offering and list on an exchange yet, because this Reg A plus offering gives your shareholders a liquidity event. After you complete your offering, your securities are registered and allowed to be traded on an over-the-counter market. The securities cannot be traded on a stock exchange like NASDAQ or the NYSE, but they can be traded over the counter. So there will be liquidity for your shareholders and investors. Last, I'd like to talk about the typical types of public offerings. And the regular way public offering, the one that we're all familiar with, is done on a registration statement on Form S1. It's a traditional IPO. It has an underwriter. You can raise an unlimited amount of money from an unlimited number of accredited and non-accredited investors. It does take a little bit of time and it does cost a little bit of money. There are specific requirements for financial statements. You need to have your last 2 years' financial statements audited, and you need to have your interim unaudited financial statements, sometimes more if it's a larger company. This presentation focuses on the microcap company requirements. After your registration statement is declared effective by the SEC, you become a reporting company. You have to file annual reports, quarterly reports, proxy statements, etc. So you'll want to have a law firm or an in-house to help you with those reports. The benefit of the S1, in addition to non-accredited investors, unlimited advertising, etc., is now your securities are eligible for trading on a stock exchange. So NASDAQ or the NYSE American or the New York Stock Exchange. A direct listing is the same as a regular way offering that we just talked about, but there's no underwriter. You can actually, as a company, directly list your securities with a stock exchange. You can raise money without an underwriter. It is difficult to do at that level, but it is done. It is completely legal. There's no legal requirement to have an underwriter for your public offering or a stock exchange listing. Last, I just wanted to briefly mention SPACs because you've probably heard of them. And a SPAC is a special purpose acquisition company. It is a shell company that was formed for the sole purpose of raising money and then using those funds to acquire operating businesses. Very popular 2021, 2022, even into 2023. However, a statistic recently came out that only approximately 28% of SPACs were successful. So they have waned in popularity in recent years. But as you can see, there are now many flexible options to raise money in the US. And these options are not mutually exclusive. Companies often use several different types of offerings throughout their growth and development. And some offerings can even be conducted at the same time. I'll leave you with a fun fact. The first IPO was in the Netherlands. The first Ponzi scheme was also in the Netherlands, and it involved tulip bulbs. Thank you for listening.
Thank you so much, Lynn, for joining us today and for sharing all of your insights. We greatly appreciate you. Anybody that wants to get in contact with Lynn, it's right here on the final slide with her email, website, and phone number. Lynn, thank you very much.
Thanks for having me. Bye-bye.